This segment is sponsored by the Norris Group. Dion Norris, CEO of the Norris Group, is back with us today to talk about how we can help with tax fundamentals as we approach the tax deadline. First of all, Dion, welcome back.
Thank you for having me.
So let's talk about it, jump right in. How do we know if we should be filing and what are the income thresholds? I guess some people may not actually have to file?
That is correct. So not everyone needs to file. If your gross income or wages, I would say, is higher than the standard deduction, whatever it is for that year, you generally have to file. If it's below that, you don't have to file. But if you are self-employed and you make more than $400 in a year, you do have to file your taxes.
So I think the key here we're learning is there's a lot of different rules, so that's why we need a professional like yourself to step us through.
That is correct. It's very, very nuanced.
Let's talk about tax brackets and how it affects our overall taxes.
So the more money you make, the higher you are in your tax bracket. So what that is wherever your final bucket of income is generally what tax bracket we say you're in. So let's say if you make $100,000 a year, you don't pay $100,000 or $100,000 worth of taxes in, let's say the 18% tax bracket or 22% tax bracket. It's just a percentage of that money that you're actually paying in that bracket. But generally when we say tax bracket, we're referring to the highest bracket you're paying taxes in.
Gotcha. So how much you make obviously directly correlates to how much you owe to Uncle Sam.
That is correct, because we are a progressive tax system here.
I gotcha. All right. So let's talk about how we can tell the difference between taxable income versus non-taxable income.
So generally, and I say generally because it's never 100%.
Of course.
Any income that you get from wages, retirements, or some type of settlement will be taxable. Things that generally are not taxable are any insurance proceeds, so life insurance, things of that nature. Sometimes an inheritance, depending on what state you live on and the value of the inheritance, may not be taxable. But it's best to consult with a tax professional so they can tell you the ins and outs of what is taxable versus what is not taxable.
Because I feel that these rules are changing oftentimes,
yes.
right?
Yes, they are.
Even if you think you understood how it all works year to year, things can work differently.
Yes, it changes year to year. The thresholds change every single year. So that's why it's important that we stay up to date on the code, but also that you seek someone who knows the latest updates.
Let's talk about it when it's come time to do your taxes. They talk about itemization versus the standard deduction. How do you know which one is better for you, or do you not know until you start working on them?
So generally, yes, we don't know until we actually start working on your return. We can ask some qualifying questions to kind of gauge whether or not itemized or standard deduction will be better for you. It's one or the other. So with the cuts that happened in 2017 with the tax code, actually more people take the standard deduction versus itemized deductions now. So that is one way we figure out. We look at what your standard deduction is, married, couple, single, etc., filing status. It changes your standard deduction. But then we look at your itemized deduction, so your mortgage insurance, real estate taxes, things of that nature, and we determine which one is more advantageous. Whatever's more advantageous, we choose that one for you.
Well, that makes a lot of sense. It can be a little tricky here. I know for myself, a lot of times I think, okay, I want to itemize. You'll go through all the lists, do all these extra categories, and then you get to the end, it's like, you should probably just do the standard.
Yes, that does happen.
Well, let's talk about if you get a notice from the IRS in the mail. What does that mean?
First off, not all notices are bad.
Okay.
So the first thing is to think that it's from the IRS, so it's automatically bad. Sometimes it's just they want to verify certain things, verify that it is you that's actually filing the return. Sometimes it may just be a compliance thing where you forgot a signature, et cetera. Or sometimes this has happened where the IRS has actually lost a copy of your return.
Oh, okay.
So they are asking you for a copy of the return. So the first thing I would say is don't be afraid when you get—
Don't panic?
Yes, don't be afraid, do not panic. Read what it actually says, and then consult someone who knows how to respond back to the IRS.
All right. Well, very helpful information. Yes. It is that time of year. Dion, thank you so much for coming here today.
Thank you.
To get in touch with Dion or the Norris Group, it's very easy. You can head to the website listed right here on your screen and get that tax help to make sure you file correctly.